Okay, dear students, let's discuss pre-scene mock September 2026. We'll be discussing section A today, and section B and C, you people are supposed to do it by yourself. If you have any queries, any problem in any of the questions, so inshallah, I'll be available to resolve your queries. Okay, so let's deal with this. What is the carrying amount of closing inventory in Harlow Company's statement of financial position as at December X5? To the nearest dollar. So we are required to calculate carrying amount of closing inventory. December X5, Harlow Company has 2,000 units of partially completed inventory in its warehouse, which costs 180 to bring their current location and condition. So right now, the cost of these 2,000 units is 1,80,000. Okay. Until November X5, Harlow Company sold completed units for 130 per unit. Until November X5, they sold each unit for 130. In November X5, a new competitor entered the market. As a result, Harlow Company received revised the selling price per unit to 95. If you student recall IAS 2, according to IAS 2, we will keep the inventory at lower of cost and NRV. So earlier we were selling it for 130, but now due to the competitor, we have revised the selling price and now it is 95. Okay. Each unit requires further processing cost of 20 as well. NRV is your selling price, but you need to deduct the further processing cost as well before it can be sold. Harlow Company's sales agent charges a fee commission 5% of the selling price on all completed sales. Now the selling price is 95. So this 5% commission is not applicable on NRV. This 5% commission is applicable on selling price. If you read the arrangements, sale agent charges a commission of 5% of the selling price on all the completed sales. So 5% is applicable on selling price. So all we need is we are required to calculate NRV of these 2,000 units. If NRV is lower than 180, then obviously we'll keep our closing inventory at NRV. If NRV comes more than 180, then obviously we'll keep our closing inventory at 180. So let's calculate NRV. Number of units are 2,000. Selling price is $95 per unit. Sales commission is applicable on selling price. So 5% is the selling commission. So I'm taking 95% of this. Whatever comes minus the further processing cost. There are 2,000 units and the further processing cost per unit is 20. So here comes your NRV. If an NRV is going to be, let's say, lower than 180, we'll keep the closing inventory at NRV. If it is going to be higher than 180, then we'll keep inventory at 180. 2,000 into 95 is the selling price. And what is this 95%? Because 5% we are paying commission on selling price. That is for 95% minus 2,000 into 20. Students, I'm getting NRV 1,40,500. So net realizable value is lower than 180. So logically, we'll keep the closing inventory. What is the carrying amount of closing inventory? Logically, the carrying amount of closing inventory is 1,40,500. 140,500. Okay. Using deferred income method IAS 20, accounting for government grant and disclosure of government assistance, which two of the following show the values which grant and asset will be presented? In the statement of financial position, year end is this. Alpha Company purchased a new machinery on July X3 start of the year for 10 million with a useful life of 10 years. The acquisition was partially funded by 3 million government grant received on the same day. Company is using a deferred income treatment. Okay, now listen. From 1st July X3, this is the date on which we have actually received 3 million government grant and we have treated this 3 million as a deferred income in day one. Now listen. The life of the asset is 10 years. Slowly and gradually, when we are going to depreciate the asset, we will amortize this government grant. And through amortization, the government grant will be converted from deferred income to, let's say, income, or you can say other income. So amortization of grant at the end of first year, 30 June X4. Amortization of government grant. The amount of the grant is 3 million. Life of the asset is 10. So every year, actually, we are amortizing zero. Every year, 0.3 million government grant will be amortized, will be converted into income. Okay, now try to understand the grant received is 3 million. Out of this 3 million, 0.3 we have converted into income. Okay, we are still left with 2.7. Now listen and listen carefully. We are at, right now we are at 30th June X4. So 30th June X4, we still have a deferred income of 2.7 million. But in next 12 months, out of this 2.7 million, 0.3 million in next 12 months, I'm counting these next 12 months from the end of 30th June X4 onwards. In next 12 months, 0.3 million will be converted into income. Because every year, 0.3 million will be converted from deferred income to income. So it logically, in next 12 months, out of 2.7, 0.3 million will be converted into income. So we can say that 0.3 million is your current liability. So if I deduct 0.3 from 2.7, logically 2.4 is going to be my non-current liability. So what is the breakup of the entire 3 million government grant received? Till the end of the year, 0.3 through amortization has been converted to income. Then we are left with 2.7. Out of this 2.7, in next 12 months, 0.3 will be earned by the company, will be converted from deferred income to income. So 0.3 is the current liability. So if we deduct 0.3 from 2.7, logically 2.4 is our non-current liability. Now let's find out. It is this. Non-current liability is 2.4, current liability is 0.3. Which two of the following are required by IAS 16? The finance director of Barocco, which uses revaluation model for its property, plant and equipment, is reviewing checklist of requirement of IAS 16 property, plant and equipment. Which two of the following are required by IAS 16? Revalue all asset under a revaluation model annually. The problem is annually. It is not necessary that you have to revalue all the asset under revaluation model annually. Not necessary at all. Under fair value model, yes, you have to see what is the fair value at the end of each year. But it is not the case when it comes to revaluation model. So in case of revaluation model, revaluing each asset annually under revaluation model, not necessary. You can revalue after every 3 years, even you can revalue after every 5 years. You can revalue even after 1 year as well. But the question is, it is not necessary to revalue all assets under revaluation model annually, not necessary. So it says revalue all assets under revaluation model annually, not necessary. Test all property, plant and equipment for impairment at least annually, I would say no. Actually, we have to see, do we have indicators of impairment loss or we don't have indicators of impairment loss. Instead of applying impairment test on these property, plant and equipment annually, organizations should check, do we have any indicators of impairment losses? Because if you have indicators of impairment loss, then you are going to perform impairment test. Review useful life and residual value at least annually, that is true. According to IAS 16, you have to review useful life and residual value at least annually. The excess depreciation from revaluation surplus to retained earning, transfer the excess after revaluation, we know that depreciation will increase. And now it says transfer excess depreciation from revaluation model, revaluation surplus to the retained earning. I would say not necessary. If you want, you can do that, but it is not necessary. It's an accounting policy. And we know that accounting policy means where we have a right to choose, we have a right to decide. So it is you have a right to choose either you want to transfer excess depreciation to the revaluation surplus or transfer from revaluation surplus to the retained earning or not. It is going to be, it is your accounting policy. It's not necessary that you have to do that. Review depreciation method apply to each asset at least annually. That is true, because if logically according to IAS 16 property plant and equipment, your depreciation method should match with the pattern of economic benefit. For example, if you will be your organization is going to get more benefit earlier and later on reduce benefit, you should be using reducing balance method for depreciation purposes. But if company says by using the asset we'll be getting more or less same benefits every year, then you will go for straight line method. So logically, if pattern of benefit associated with the asset changes, then you have to change the depreciation method. And change in depreciation method is treated as change in estimate. Change in estimate is applied prospectively. Here, statement I would say C and E is, these two statements are correct. Okay. Which of the following statement is correct when determining the transaction price? Okay. Where a contract has a variable consideration with multiple possible outcomes, an entity must always estimate the transaction by using most likely outcome. This is not the case. Where a contract, when you are having a variable consideration, then according to IFRS 15, you have to check that if your estimates are not going to see the significant reversal, then variable consideration should be considered. Otherwise, you are not going to consider the variable consideration. If contract includes a penalty for late delivery, the penalty should be deducted in arriving at the transaction price only if it is highly probable that penalty will be paid. Now, this one makes sense. The second one, if a contract includes a penalty for the late delivery, if the contract includes a penalty for the late delivery, so logically, if it looks that we are going to bear that penalty, then you should deduct that penalty from the transaction price. The penalty should be deducted in arriving at the transaction price only if it is highly probable that you are going to bear that penalty. For a contract that will be settled in 11 months, I'm not going to discount. Where an entity sells goods and expects some to be returned by the contract, it should recognize the revenue in full and create a no. Where an entity sells goods and expects some to be returned by the customer, it should recognize revenue in full. You cannot recognize revenue in full. So logically, B is the answer. Which two of the following factors could have led to this decrease? Which two of the following factors? Okay. Operating profit margin of Spring Company has dropped from 20% to 16%. Profitability of the organization has decreased from 20 to 16. An examiner is asking us which two of the following factors could have led this. So let us find out the two reasons. Due to that, operating profit margin has reduced from 20 to 16. The Spring Company debt financing provides increased interest. This one is false. Why? Because operating profit margin is the operating profit is the profit which is before deducting the interest. So even the interest rate increases, it has no impact on operating profit margin. After conducting a review of tangible assets, Spring Company decided to reduce the useful life of the machinery and equipment. That is logical. Try to understand. After conducting a review of tangible assets, Spring Company decided to reduce useful life. Now listen, if we are going to reduce the useful life, logically depreciation will increase. Obviously, if the depreciation will increase, then your operating profit will decrease. Organization has reviewed the useful life and they have decided to reduce the useful life of the tangible asset. Reducing the useful life of tangible asset means depreciation has increased, and due to increase in depreciation, Logically, operating profit margin has reduced. Okay. The Spring company was able to negotiate better deals and obtain price reduction on a raw material purchase. Actually, this is false. Why? If you were able to get a better deal and you bought the purchases at a reduced price, then logically your operating profit margin should increase rather than decrease. And the scenario which is in front of us is here operating profit margin has decreased, not increased. So actually statement number 3 is representing increase in operating profit margin. But right now we are here to find out the reason of decrease in operating profit margin. That is why statement number C is wrong. Spring company increased the wages of the managerial staff in response to the new government policies of on minimum wages. That is true. Obviously, when we are increasing the staff wages, so operating profit margin will reduce. So logically, statement B and D, they are the reasons, causes of decrease in operating profit margin. Calculate the gain on investment to be recognized in Arena company's statement of P&L or OCI on this date. Okay. 1st April X5, Arena company made an investment in ordinary shares. IFRS 9 of Brown company paying 10 million for the shares and additional 1 million broker fees. The shareholding was less than 2%. Arena company made an irrevocable election. Now listen, students, and listen carefully. If they have made an irrevocable election, one, initially your investment will be carried at fair value plus transaction cost. Later on each reporting date, we have to see what is the fair value of the asset, and the difference, either gain or loss, will go to OCI. Initially investment value is 11 million. December X5, the fair value of the investment is 12. So from 11, it becomes 12. And it was correctly accounted for. On 30th June X6, Arena company sold the entire investment for cash consideration 13. So logically, your investment was at 12, you sold it for 13. So there's a 1 million gain. You can say there's a 1 million gain on disposal, and that gain goes to OCI. 1 million OCI. There's a 1 million gain, and that will go to OCI, other comprehensive income. Which two of the following statements are correct regarding the deferred tax charge for the year ended this? Okay. The following information relates to King Company for the year ended December X6. At December X6, the carrying amount of King Company's property, plant and equipment before any revaluation was 540. Tax base is 5 lakh. So carrying amount. Tax base and temporary difference. Property, plant and equipment 540 is before revaluation. Tax base is 5 lakh. So we are having a 40,000. Assets carrying amount is more than the tax base. So the difference is your taxable temporary difference. And we know that taxable temporary difference multiplied by tax rate will give you the deferred tax liability. And that is going to be your closing deferred tax liability because of December X6 year end. Okay. During the year ended December X6, one of item property, plant and equipment was revalued upward by 30,000. Now listen to me carefully, student. Logically, due to 30,000, you can say carrying amount of the property, plant and equipment will increase, but taxation authorities do not accept your revaluation. So logically, the tax base of revaluation is going to be 0. So carrying amount will increase by 30,000. Tax base will have no impact of this revaluation. Logically, the 30,000 difference of carrying amount tax base will result in a taxable temporary difference. But 30,000 into tax rate, whatever comes, the impact of that deferred tax liability will go to OCI. Why? Because according to IAS 12 income taxes, if your deferred tax liability arises from equity items, so the impact will also charge to equity. Opening liability 7,500, income tax rate is 30%. So logically, you can show revaluation separately. There's no harm at all. Revaluation surplus, which is technically increasing your property, plant and equipment. Revaluation surplus is 30,000. Logically, the tax base is 0 because taxation authorities do not accept revaluation surplus. It is also taxable temporary difference. But now you need to understand. 40,000 multiplied by 30%. I'm getting 12,000. Logically 12,000. And opening liability is 7,500. I'm getting 4,500. Logically, this 4,500 is your deferred tax expense. Now you might be thinking, sir, what about this revaluation surplus? I'll tell you. 30,000 is a taxable indemnity difference because of that revaluation multiplied by 30%. This 9,000 is your deferred tax liability, but that will be charged to OCI. What will be the double entry? Let me explain that. Debit, credit. Deferred tax expense. Logically, deferred tax expense will be debited by 4,500. Revaluation surplus OCI will be debited by 9,000. Deferred tax liability will be credited. Just a minute. 4,500 plus 9,000. Deferred tax liability will be credited by 13,500. Plus, if your examiner is asking what is the closing deferred tax liability at December X5, opening liability is 7,500, closing, we will add this 13,500. Here comes the closing liability. Then we'll see the choices. 7,500 plus 13,500. Student, logically, the closing deferred tax liability is 21,000. Now come here. A charge of 12,000 recognized in P&L, false. A charge of 9,000 will be recognized in OCI, true. A charge of 4,500 will be recognized in P&L, true. A charge of 21,000 will be recognized in P&L, wrong. 13,500 will be recognized in OCI, wrong. So logically, the answer is B and C. We have found other things also, but examiner did not ask. Current year deferred tax liability increases 13,500. Closing deferred tax liability is 21,000. But examiner did not ask that. So logically, the answer is B and C. What was the amount of cash consideration paid by Diamond Company for the investment in Sapphire Company? What was the amount of cash consideration? Student, if you recall, how do we calculate goodwill? We need investment in subsidiary by parent. We need NCI at acquisition. Whatever comes, simply less fair value of net assets at acquisition. Then here comes the goodwill. Okay, come. On 1st May X5, Diamond Company acquired 75% ordinary share capital of Sapphire Company through initial cash payment and agreement to pay contingent consideration to the shareholders of Sapphire Company. The fair value of the contingent consideration is 350 by Diamond Company on this date. So actually, fair value of contingent consideration examiner has given us. Fair value of contingent consideration examiner has given us how much? 3,50,000. Problem is we don't know cash consideration. Let's take Y. Okay. Diamond Company calculates just right. Diamond Company calculates non-controlling interest using the fair value at the date of acquisition, which was estimated to be 150. So fair value of NCI they have given us. Fair value of NCI is 150. Logically, you can say 350 plus 150, it is 500,000 plus Y, which we don't know, which we have to find out. Okay. The following figures for Diamond are relevant. Ordinary share capital is 600, retained earning January X5, but the date of acquisition is 1st. We need retained earning at acquisition, first May X5. For the year ended, the profit is 140. The profit of Sapphire company have accrued evenly throughout the year. Now listen to me carefully, students. 140 is the profit of 12 months, but logically we acquired the subsidy during the year. So 140 is a profit of, I would say, 12 months. Out of this 12, we will take 4 months the profit and add it. We will add that 4 months profit to this 350. Logically, 350 is the retained earning at January X5, and we need to have the profit of next 4 months as well, because our date of acquisition is 1st May X5. So after adding profit of next 4 months to 350, logically you will get retained earning at acquisition. So let's see what we are getting. 144 by 12. I'm getting 46 point. Answer of only this is 46.67. Logically, 350 plus 46.67. Retained earning at acquisition means 1st May X5. Retained earning at acquisition is 396.67. Share capital is 600 less fair value of net assets at acquisition. Share capital, they have given us 600,000. Logically, retained earning at acquisition is 3,96,670. Okay. Whatever comes, it will be deducted to get the goodwill. And they have given us the goodwill. The value of the goodwill is how much? Goodwill is 400,000. Goodwill is 400,000. Okay, great. Now come in. We know that logically 500,000 plus y. Whatever is the total, from this total, we will deduct, just a minute, 600,000 plus 396670. We'll deduct 996670. If we deduct 996670 from 500,000 plus y, then logically the final answer is this 400,000. Now, please, a little maths is involved. If we deduct 996670 from this above total, then I will get this goodwill. So what is the above total? It's very simple. 996670, add 400,000 to that. If you add 400,000 to that, logically, we are getting 1396670. How did I get this 1396670? Please, it's a very simple math. You need to understand one thing. After deducting 9,96,670 from the total of 5 lakh plus y, I'll get 400,000. So logically, what I did, a reverse working. I have added 4 lakh to the 9,96670. Now, if you deduct 9,96,670 from 1396670, you will get 4 lakh. Now, very easily I can get y, because 500,000 plus y must be equal to this value. Now, simply deduct 500,000 from 1396670. Difference is going to be y, which is your cash consideration. So let's deduct 5 lakh. After deducting the 500,000 from above value, students, I'm getting 8,96,670. So according to my mathematical, I would say, calculation, cash consideration is 8 lakh 96,670. It's very easy. Within this 500,000, if you add 8,96,670, you will get 1.39 million. And from that, if you deduct 996670, you will get goodwill 4 lakh. Do we have any options? Oh, let's go to the closest one. So the closest one is the D. Okay, let's go ahead. What is the warranty provision that Walker company should recognize in its financial position on this date? Walker company reporting date is 30th June X5. Walker company provides a 1-year warranty with each unit sold during their ended 30th June X5. During their Walker company sold 2,000 units. No warranty claims settled by this. Okay. Walker company reported date is this. Walker company provides 1-year warranty. They sold 2,000 units. During their ended this, they sold how many units? 2,000. Past experience indicates no repairs are required for 80% of the goods sold. So logically, 2,000 into 80%, there will be no warranty claim. 0. On average, 15% of goods sold require minor repairs, and the cost is 600 per unit. And the remaining 5% requires major repair, and the cost is 20,000 or 12,000. Now listen to me carefully. Logically, 2,000 into 80%, no repairs, 0. But 2,000 into 15% minor repairs, and the cost is 600. 2,000 into 5% major repair, 12,000. So here comes simply 2,000 into 15% to 600. I am getting 180. 2,000 into 5% into 12,000. 1.2 million. So students, I'm getting 1.38 million. Let's see, do we have any options? No, we don't have. It's okay. Okay, 13800. Fine. How will this change in accounting policy impact the financial statement of Gillard company for the year ended? What change they have made? We have no idea. Let's read. Gillard company applied the cost model for its investment properties for many years. Many years they were using cost model. Okay. Starting from 1st July X5, the company shifted to fair value model of investment for investment properties. Now listen to me carefully, students. Under under fair value model, investment properties under fair value model, number one, no depreciation. Second, whatever the change comes in the fair value, logically that change goes to P&L. If I bring little bit IFRS 18 here, logically then that change you have to show under, I would say, investing category. Since fair values were higher than the carrying amount for all the investment property, fair value gain, they recognize a 40 million gain. Wow, wow, wow. No change in the estimated useful life of the property investment properties. How will this change in accounting policy impact the financial statement of Gillard? Let's see. Both operating profit margin and gearing will, oh no. Operating profit margin will increase, makes sense. But gearing, logically, when your profitability will increase, due to increase in profitability, your equity will increase. Due to increase in equity, your gearing will reduce, not increase. So first statement you can say is partially correct, partially incorrect. So obviously I'll mark it false. Both profit before tax and gearing will decrease. I would say that is again partially correct, because due to increase in profitability, increase in equity, gearing will reduce, but profit will increase. That is also false. Profit before tax will increase and gearing will decrease. Absolutely true. No need to read any other thing. Due to gain on investment properties, profitability will increase. Obviously, increase in profitability means equity increases. Increase in equity means gearing will reduce. Gearing is the debt to equity ratio. So obviously, when there is going to be a rise in the equity, so automatically debt to equity ratio will reduce. Which of the following best describes the objective of IFRS 1 S1 general requirement for disclosure and sustainability related financial information. To establish disclosure requirement exclusively climate related, you should be thinking for S2, not S1. To provide a framework that guides companies how to develop and communicate their sustainability strategy to all stakeholders, including employees, government, and communities. To require companies to disclose information about sustainability related risk and opportunities that is useful to investor making risk. This is the main thing. Why actually even we have developed IFRS S1, S2 just because of, I would say, investors. Because today's student investors, they just don't want to see the profitability of your organization. They actually want to see how you are using the available resources, the way you are conducting your business, what impact it is creating on the environment. So they want to see sustainability of your business rather than only the profitability. So logically, C is the answer. Okay. The following information has been extracted from the financial statement of Louis Company for the year ended December X5. Operating profit is 620. What we need to do? Calculate cash generated from operation for the year ended December X5 to the nearest dollar. Okay. Operating profit is 6,20,000. Profit before income tax is 5 lakhs. So the difference is, you can say, finance cost. Depreciation is 80,000. Loss and disposal is 20. Increase in inventory is 35. That's increase in inventory. Decrease in trade receivable is 25. Increase in receivable is 15. Now listen. I'll take operating profit 6,20,000. Depreciation we will add back. Logically, we have deducted the depreciation while calculating operating profit, but we'll add back because it's a non-cash item. Loss and disposal we will add back. It has been deducted. Increase in inventory. Logically, due to increase in inventory, profitability has been increased. But if you, right now we are looking for the cash in and cash out, more investment in inventory means logically outflow of cash rather than increasing the cash. So why we are deducting 35,000? Increase in inventory has actually increased the profitability, not the cash. Decrease in trade and other receivable, this should be added because this much we have received. Increase in trade and other payable will be added because we have not paid. So here comes the cash from generated from operations. 6,20,000 plus 80,000 plus 20 minus 35 plus 25 plus 15. Students, I am getting 7,25,000. Wow. Okay. What is the diluted EPS of Charlotte Company, December X5? Charlotte Company has issued share capital 5 million of on January X5 at a par value 1. So 500,000, 5 million is number of shares at the start of there. On 1st September X5, Charlotte Company made a bonus of 2 new shares for every 5 shares held. They have given us a profit after tax and they have given us a convertible loan. Loan notes are 300,000. Coupon rate is 5%. Loan note conversion is 60 shares per 100. Tax rate is this. Okay, fine. First of all, initially they have given us 5 million shares. And after that, in the entire question, we have got bonus issue, nothing else. So whenever you have in the entire question, you have got just bonus issue, then normally we assume that bonus was made at the start of the year. Otherwise, you can do this also. 500,000. Simply, I'll add the bonus. How many bonus shares company has issued? 2 for every 5. 2 million. So you can say that at the start of the year, company was having 7 million shares. Now, while calculating diluted EPS, we make the assumption. The assumption is that all potential ordinary shares, they are converted to ordinary in day 1. So we will add shares due to conversion. Add shares from conversion. Convertible loan amount is 300,000. Each bond is converted into 60 shares, and the par value of each bond is 180. So here comes your, I would say 718000. So 718000 is your weighted average number of shares. Now we need profit. Profit after tax, existing profit after tax, student, they have given us 7,56,000. Of course, we have now converted convertible bond to ordinary shares, so we are not going to pay any interest. So simply add back. Post tax means after tax. Post tax interest saving. Convertible bond amount is 300,000. Just a minute. Just a minute. Post tax interest saving 300,000 into 5%. I hope the coupon rate is 5% into 1 minus tax rate. So 300,000, if you take 5% of that, you will get 15,000 into 0.7. From where I'm getting 0.7, 1 minus 0.3. I'm getting 10,500. Here comes your revised PAT. 7,66,500. So very easily we can calculate diluted EPS. 7,66,500 divided by 7.18 million. Okay. So let's see what are we getting. Students, I am getting $0.1067. If you do not get the exact answer, obviously we'll go to the closest one. And the closest one is the first one. Okay. Which of the following is correct regarding Leslie's factoring of trade receivable for the year ended December X3? On December X3, Leslie company sold 2 million of trade receivable to Rely company. Leslie company receives an immediate payment of 1.8 million under the factoring agreement. Any receivable not collected after 6 months will be sold back to Leslie. So logically, the entire 1.8 million is your loan, it's your liability, because you actually, when I'm selling the data, when I'm selling my accounts receivable, there is only one risk when I have data in my books, and the risk is risk of bad debts. And logically, if you look at the arrangement, we are still facing that risk, because if factor company is unable to collect, so we have to refund the amount. If they are unable to collect the, let's say, entire amount, so whatever we have received from the factor company, we have to give that amount back to them. So logically, risk and awards we have not transferred. You can say it's a with recourse factoring. So whatever amount we have received, it is simply a liability for us. Receipt of 1.8 million should be treated as a loan liability. Okay. What impairment reversal should be recognized in Rio company's statement of P&L for the year ended this? Reversal of impairment. Okay. On January X1, Rio company purchased plant for 6 million and began to depreciate it on straight line basis over a useful life of 10 years. At December X5, the plant was damaged by an electrical fault and was tested for impairment. The recoverable amount of the plant was 2.5 million. Now stop. First of all, 11X1, I'm ignoring 3 zeros, I'm taking just 6,000. Plant was bought for 6,000. After 5 years, we can see there's an impairment. After 5 years, there's an impairment. Now listen, before applying the impairment test, before impairment review, first we have to calculate the carrying amount of our plant. So from 11X5 till December X5, the time period is 5 years. Entire life is 10. So simply, I'll deduct the accumulated depreciation. Logically, at the time of impairment review, the carrying amount is 3,000. Recoverable amount they have given us is 2,500. So logically, December X5, impairment loss is 500. Impairment loss is 500,000. Okay. I've ignored 3 zeros. Okay, fine. And after impairment, we have to depreciate the asset over its remaining life. And the remaining life is 5 years. Okay, the plant was fully repaired and restored to its maximum production capacity. Recoverable amount by December X6, the recoverable amount is 2.6 million. So December X6, we can see there is a reversal of impairment loss because now the recoverable amount has increased. Okay, now what to do? Let's see. First of all, whenever there is a reversal of impairment loss, according to IAS 36, the maximum reversal, I'm talking about the maximum reversal could be the difference between whatever carrying amount right now you are having in your books. And second, if there was no impairment loss, then what would have been the carrying amount in your books? The difference is going to be the maximum reversal. Reversal less than that is possible, but more than that is not possible. Let's see from every angle. First of all, December X6, 2,500 plant depreciation, 2,500 1 upon 5. It's a 500 depreciation. Carrying amount is 2,000. Now listen to me carefully, sir. The carrying amount is 2,000. December X6, the carrying amount is 2,000. Examiner has given us the recoverable amount. Recoverable amount is 2,600. Now the question is, can we recognize the reversal of 600? Obviously not possible. We are going to compare this because impairment loss which we have recognized, it is 500. So reversal of 600 is not possible. According to IAS 16, the maximum reversal is the difference of two values. One, the carrying amount which you have right now at the time of reversal, I have a carrying amount 2,000. Compare this with the historical cost. Take the historical cost, less all the depreciation, and try to calculate the carrying amount. If there was no impairment loss, what would have been the carrying amount on the day of reversal? Originally, the plant costed us 6 million. From January X1 till December X6, the time period is 6 years. If I deduct 6-year accumulated depreciation, let's see what I'm getting, 3,600. So I'll get 2,400. Now listen to me carefully. Student, the maximum reversal is going to be the difference between 2,000 and 2,400. So the maximum reversal which we can do is the difference between 2,000 and 2,400. So maximum, I would say, reversal is 400,000. So students, that is all about pre-scene FR pre-scene mock September 2026. We have discussed section A, and to all of my enrolled students, kindly listen and listen carefully. You have to attempt section B and C by yourself. If you come across with, I would say, any difficulty, so you are required to ask queries directly from me. As you know that we do not keep any teacher assistants. All the queries I'm going to reply personally, but it is my recommendation, do not ignore section B and C of the pre-scene mock. Do not ignore me, do not ignore. Plus students, my WhatsApp support is available till the last day of exam. Plus You know that we are the only institute we conduct your weekly live revision classes, and that is all together is today I conducted your class number, I believe 10 or maybe 11. So it was your class number 10th or maybe 11th class. But of course, now the exams are extremely near, so no more live revision classes. Now exams are there just after, I would say, 1 week you are going to have exams. But students, my WhatsApp support is available till the last day of exam. Plus, FR crash course is already uploaded on the portal. It is already there. You are not supposed to pay any additional fees for the crash course. Just by spending 7 to 8 hours, you can revise the entire FR. Plus, student, I strongly believe each one of you is having my FR short notes as well. I would say within 2 hours, you can revise entire FR by, I would say, using my short notes. And one more thing, students, in all ACCA papers, we are the only institute we conduct your live revision classes. You know that. Plus, in each paper, crash courses are available, and we are the only institute that we provide the best crash courses in the entire world. For example, in PM, there are two types of crash courses. One is a topical crash course. By spending 5 to 6 hours, a student can revise the entire PM. Second crash course is again 5 to 6 hours long. That is a question-based crash course. When it comes to, I would say, taxation, there are again two types of crash courses. Mainly, I would say the topical crash course in taxation is just 5 to 6 hours. So by spending 5 to 6 hours, you can revise the entire taxation. In FR, you need to just spend 7 to 8 hours to revise the entire FR. In financial management, there are two types of crash courses. One is a topical crash course. Again, by spending 5 to 6 hours, you can revise entire FM. In SBR, students, there are two types of crash courses. One is IAS and IFRS crash course, 7 hours long. Another is SBR consolidation crash course, that is also 7 hours long. In ATX, the crash course is hardly 10 to 11 hours long. By spending 10 to 11 hours, you can revise entire ATX. In AFM, students, by spending 15 to 16 hours, you can revise entire advanced financial management. Plus, student, you know that our WhatsApp support, which we offer to our students, it is the best and quickest in the world. Normally, we reply to our students within 3 to 5 minutes. And again, all the, I would say, queries are resolved by your tutors. We do not keep any teacher assistant. So that is all from my side. So thank you very much. Best of luck for the exam. And my WhatsApp support is available till the last day of exam. So far, highest marks taken in FR by my student, they are 92. Let's see who is going to get more than that in this attempt. I'm expecting some of the students, they are going to get really good marks, obviously, in this attempt, inshallah. So, and you know that in number of ACCA papers, we have produced, I would say, world top as well. So thank you very much. Hope to see you all and others in the next papers as well.